luxury fashion has often been one of the first sectors to reflect changing consumer confidence. Are today's weaker sales simply a fashion trend, or are they another signal that global liquidity remains tighter than most investors realize? Welcome to Business and Wealth Strategy. My name's Karen Newton. Bonjour, hola, ni hao. Recent months have seen an increasing number of celebrity endorsements. Particularly, I've been noticed promoting men's luxury accessories. Now, I follow things right around the world, actually, and look at what is happening. And I have noticed a couple of Chinese actors who have become really increasingly high-profile ambassadors for luxury brands. The two actors that I'm looking at, and apologies if I pronounce their names wrong, Xiong Linghe and Song Weilong. Now, they seem to be signed up as brand ambassadors for brand after brand after brand. Huge amount of brands they're promoting. But it's not just the Chinese active market. I noticed it through the World Cup, the Soccer World Cup. You've got people like Jude Bellingham, the English midfielder, and France's captain. They have generated media value in excess of over $1 million each for Louis Vuitton. Now, I'll say Louis Vuitton and Dior. Now, they are targeting a specific market, and this is future generation male buyers. Because one of the things with the fashion industry is they tend to think long term, and they realize that if the first purchase that a person makes is with their brand, that person tends to remain loyal to them. So these high endorsements, even though the fashion industry is in decline, means that fashion houses are taking the long-term strategy for future sales. So what does that mean for us as investors? We know currently that liquidity is getting tighter. And if you follow my blogs, my videos, or my podcasts, particularly over the last 5 or 6 weeks, you'll see that there has been a trend on how tight liquidity is starting to become. So when we see these fashion houses spending so much money on long-term strategies, is that something that we ourselves as investors should be thinking about? Or should we be saying, well, I can see liquidity is getting tight. Is it time to get out of this particular market? Now, a lot of the decisions will come down to whether you're a trader or an investor. Traders tend to be now short-term, looking at where they can make the next dollar. Whereas investors tend to look at the markets that are going down, where they can buy cheaper and hold long-term. So with the fashion industry, whatever your strategy is, we have got these signals coming out at the moment of slower growth and declining profits. Now, softer demand, I'll say softer demand, is emerging in markets such as China, parts of the Middle East, and even some luxury retailers in the UK are saying that they're experiencing their most challenging trading conditions. So the contrast is really quite striking at the moment. You have, on one hand, the brand spending millions of dollars, and on the other side of it, Their sales are actually dropping, but they're investing in the long-term market. So one of the things is celebrity influence as powerful today as it was if sales are actually declining? And that answer is in the targeting of the campaigns. The global luxury, and I'm going to look at my notes, so apologies if I don't seem to be looking at you face on at the moment. I've got some numbers here that I'm going to be quoting. I want to make sure I've got them right. The global luxury menswear market is estimated to be around 72 billion US dollars. And over the next few years, that is expected to exceed $107 billion. So fashion houses, although they're in a downturn at the moment, they can clearly see significant long-term growth potential, particularly in the men's luxury products. Now, equally important is that their future customers, millennials, already account for around 45% of global luxury spending, while Generation Z contributes approximately 20%. Together, these younger generations now represent around 2/3 of the luxury purchases worldwide. So this explains why brands are choosing ambassadors such as Zhang Ningbo and Song Weilong, who are in that bracket of being under 30. So the potential customers and the current high-value customers are seeing younger generation influencers promoting their brands. This gives that connection. A customer who buys, and I've already mentioned this, customer who buys the first Gucci or Louis Vuitton accessory in their 20s tends to go on and purchase luggage, watches, shoes, tailoring all over several decades. So by nurturing that younger generation, they're building a long-term relationship, which turns out to be far more valuable long-term than a single sale. Now, one of the biggest problems with luxury purchases is, by nature, they're discretionary. A designer handbag can always be postponed. Right? Mortgage payments, rent, household bills, everyday living expenses, they can't. You have to cover your day-to-day living costs. So as liquidity becomes tighter, even consumers who aspire to have luxury products are now deciding that now is not the right time for them to buy. And that's where we're seeing this contrast between the advertising that the luxury brands are doing, but also the contraction that is happening within the luxury industry. Now, another economic factor that we take into account when, I take into account when looking at luxury items is luxury brands aren't simply selling a product. They sell confidence. You see, when consumers are optimistic about their financial future, they're more happy to buy the luxury brands. When liquidity tightens, those purchases are among the first to be delayed. So the distinction between different customer groups becomes increasingly important. The world's wealthiest consumers they'll still continue to buy. They might tighten slightly, but they do still continue to buy. However, it's the aspirational buyers who have had to save a little bit to be able to buy that luxury item they were looking for. They tend to sharpen and put the sale off until later. So that could be some of the reason why we're seeing luxury brands not making as many sales as normal. Their profits are declining, their growth is lower, even though they are spending a lot more. Now, over recent weeks, I have looked at several liquidity indicators. One has been the rising household debt, another has been what's happening within the property markets. Now we have the luxury industry. We are seeing this slow contraction in liquidity. And that, in turn, will lead on to other things within the market. We can look at one thing and we can see a very small ripple. We can bring several things together and see a ripple effect that gets larger. And at the moment, this ripple effect is showing us that most economies are actually slowing down. As liquidity gets tighter, purse strings are also getting harder to open. So we do have this forewarning of what is to come in the future. I hope that's helping you to understand a little more about liquidity, because I have spent quite a bit of time throughout the month of July delving into liquidity and demonstrating what is happening within those markets. And now we're starting to get this stack of numerous indicators showing us that that liquidity is across the board. It is getting tighter. Thank you for listening today. My name is Karen Newton. I'm a business and wealth strategist. If you have had any benefit from this, then please share, like. It helps me quite a bit. It helps get the message out there. If there is any topic that you would like me to cover around investing and business, then please feel free to drop me a line and let me know. Thank you.
Disclaimer. The information shared in this podcast is for educational and informational purposes only. It is not intended as financial, investment, legal, or tax advice and should not be construed as such. I am not a licensed financial advisor, and the strategies discussed are based on personal experience and general market knowledge. Always do your own research and consider your individual financial goals, risk tolerance, and personal circumstances before making any investment decisions. I strongly recommend that you consult with a qualified financial advisor or licensed professional before acting on any information discussed in this podcast. Investing involves risk, and past performance is not indicative of future results. By listening to this podcast, you agree that the host and associated entities are not responsible for any losses or damages arising from the use of this content.